What if I told you we can predict the exact moment before a crash hits? Because economic crashes don't just appear, they announce themselves. And right now, those announcements are screaming. There's a pattern that has repeated through every major collapse in modern history, a three-stage timeline from early warning to danger zone to too late. We saw it in 1929, we saw it in 2000, we saw it in 2008. And the same pattern is unfolding right now, but this time the signals are deeper, faster, and more synchronized than ever. The question isn't if a crash is coming, it's where we are on that timeline right now. So stay until the end to see where we stand and hit that like button if you want to stay ahead. Let me show you something that will change how you see every economic crash. Imagine a stopwatch counting down. Stage 1 is when the timer starts. Stage 2 is the warning beep. Stage 3 is when it hits 0. And every major collapse in the last 100 years has followed this exact same countdown. Let's go back to 1929. Stage 1 began in early 1928 when the yield curve inverted and corporate debt started piling up. Most people ignored it. The market kept climbing. Then came stage 2 in mid-1929. Unemployment ticked up slightly. A few banks started failing, but stocks hit new record highs. Everyone thought the good times would last forever. Then stage 3 arrived in October. Mass panic, bank runs, and the entire market collapsed by 80% in just weeks. Fast forward to 2000. Stage 1 started in 1998 when the yield curve flipped and tech companies began burning through cash faster than they could raise it. Nobody cared. The NASDAQ soared. Stage 2 hit in late 1999. Earnings warnings started appearing. Venture capital dried up, but the market kept pushing higher. Then came stage 3 in March 2000. The dot-com bubble burst. Trillions evaporated overnight, and then 2008. Stage 1 began in 2006 when the curve inverted and subprime delinquencies started rising. The market rallied for another year. Stage 2 arrived in 2007. Bear Stearns collapsed, mortgage defaults accelerated, but the S&P 500 hit all-time highs in October. Then Stage 3 struck in September 2008. Lehman Brothers failed. The global financial system froze. Chaos every single time. The pattern repeats. Early warning that gets ignored. Danger zone where everything looks fine on the surface. And then the sudden collapse that catches everyone by surprise. Here's what makes this timeline so predictive. Stage 1 typically lasts 6 to 18 months. That's the window where leading indicators start flashing red, but the economy still appears strong. Stage 2 lasts 2 to 6 months. 2, that's when the cracks become visible, but denial peaks. And stage 3, that's 0 to 2 months of pure panic, where it's already too late to protect yourself. Think of it like a building with structural damage. Stage 1 is when the foundation starts cracking. Stage 2 is when the walls begin to shift. Stage 3 is when the whole thing comes down. The only question is, where are we now? Stage 1 is where most people miss everything because the signals are there screaming at us, but they're hidden beneath layers of optimism and denial. Let me walk you through the 5 key indicators that have appeared before every single crash, 6 to 18 months before the collapse. First, the yield curve inversion. This is the granddaddy of all warning signs. In 1928, it inverted a full 17 months before the crash. In 2000, 14 months. In 2006, 16 months. Why does it matter? Because when short-term rates rise above long-term rates, it means the bond market, the smartest money in the room, is terrified of the immediate future. They would rather lock their money away for 10 years than lend it for 6 months. That's not normal. That's fear. Second, M2 money supply contraction. Think of M2 as the economy's bloodstream. It measures all the cash, checking accounts, and savings flowing through the system. When it contracts, when that blood supply shrinks, the economy starts suffocating. We saw M2 contract before 1929. We saw it contract in 2008. And right now, it's contracting again for the first time in decades. When money disappears from the system, something has to break. Third, corporate debt refinancing stress. This one's simple but brutal. Companies borrow money constantly to grow, to operate, to survive. But when interest rates spike, refinancing that debt becomes expensive. In stage one, you start seeing companies struggle to roll over their loans. They're not defaulting yet, but the stress is building. In 1928, corporate debt was manageable. In 2007, it was elevated. Today, it's at record-breaking levels. And with rates where they are now, refinancing has become a nightmare. Fourth, consumer savings depletion rate. This is the hidden killer. After 2020, Americans had over $2.5 trillion in excess savings from stimulus checks and pandemic lockdowns. That cushion kept spending alive even as warning signs appeared, but watch what happens when that cushion disappears. Credit card balances surge, delinquencies rise, people start choosing between groceries and rent. That's stage one. The armor is cracking. Fifth, the leading economic index, or LEI. This is a composite of 10 different indicators, everything from manufacturing orders to building permits to stock prices. When the LEI turns negative, it's never been wrong. It turned negative in 1929, in 2000, in 2007, and it's turning negative again right now. Here's where it gets interesting. In every case, the market ignored these signals for months. Why? Because human psychology doesn't work on data. It works on emotion. You're probably thinking, but the economy looks fine right now. That's exactly what people said in 1928, 1999, and 2006. The stock market was booming in all three cases. Unemployment was low. Consumer confidence was high. Everything on the surface looked perfect. But beneath that surface, the foundation was rotting, the yield curve was screaming, money supply was shrinking, corporate debt was piling up, savings were evaporating, and the LEI was flashing red. Every single warning light was on. People just refused to look at the dashboard. That's the trap of stage one. It's invisible to most people. The economy feels strong. The media celebrates record highs. Your 401k looks great. So why would you believe that a crash is coming? By the time most people see the danger, by the time the warnings become obvious, we're already in stage two. And the window to prepare is closing fast. If this is making sense, drop a like and subscribe. We're just getting to the critical part. This is where things get dangerous, because stage two is the ultimate illusion. On the surface, everything looks perfect. Record stock prices, low unemployment, strong consumer spending. The headlines are celebrating the resilience of the economy. But underneath, the cracks are spreading. Let's talk about what actually happens in stage two, that critical 2 to 6 month window before everything collapses. The first sign is the unemployment uptick, not a crash, not mass layoffs. Just a small, steady increase. In 1929, unemployment rose from 3% to 4% in the months before the crash. Nobody panicked. In 2007, it ticked up from 4.4 to 4.7%. The media called it a blip. But that slow, steady climb, that's the economy's way of saying the foundation is cracking. Second, corporate earnings warnings. This is when the biggest companies in the world start admitting that profits are slowing. In early 2000, tech giants began missing revenue targets. In 2007, banks started reporting unexpected losses. These aren't small companies. These are the pillars of the economy. And when they start warning that the good times are ending, it's not a drill. But here's the twist. Even as earnings warnings pile up, stock prices keep rising because investors believe it's temporary. They believe the next quarter will be better. They're wrong. Third, commercial bankruptcies spike. Small and mid-sized businesses start failing at accelerating rates. In stage one, it's just a few here and there, but in stage two, the numbers jump. In 2008, commercial bankruptcies doubled in the 6 months before Lehman collapsed. Right now, commercial bankruptcies are at levels we haven't seen since the financial crisis. Restaurants closing, retailers shuttering, logistics companies going under. It's happening quietly, away from the headlines. But it's happening. Fourth, credit card delinquencies accelerate. This is the canary in the coal mine for consumer health. When people start missing credit card payments, it means they've run out of options. They've burned through savings. They've maxed out their credit, and they're choosing which bills to skip. In 2007, delinquencies started climbing in the spring. By fall, the financial system was in free fall. Today, delinquencies are rising faster than any time since 2008. The consumer is breaking. And here's the fifth indicator, the one that confuses everyone. Stock markets hitting new highs. In 1928, the market rallied 50% after the yield curve inverted. In 2007, the S&P 500 hit an all-time high in October, just weeks before the crash began. People look at these rallies and think, see, everything's fine. The warnings were wrong. But that's the trap. The market always peaks right before the fall. It's not a sign of strength. It's the final gasp before the collapse. And here's the scariest part. Stage 2 is when denial peaks. People refuse to believe anything is wrong because everything looks so good. You tell someone the economy is in danger and they point to their rising portfolio. You show them the unemployment data and they say it's just noise. You mention the bankruptcies and they shrug. The cognitive dissonance is overwhelming. How can stocks be UP while everything else is breaking? The answer is simple. The market is always the last to know. By the time stock prices crash, the real economy has already been collapsing for months. That's the pattern. That's the timeline. Stage 2 typically lasts 2 to 6 months. That's the window between everything looks fine and how did this happen so fast? Stage 2 is the eye of the storm. It feels calm. It feels safe. But the worst is yet to come. And if you're waiting for the media to tell you we're in danger, you're already too late. Stage 3 is panic. Stage 3 is too late. Stage 3 is when the crowd wakes up. This is the final phase, the 0 to 2 month window before total collapse. And by the time you reach stage 3, the damage is already done. Let me paint the picture of what stage 3 actually looks like. First, mass layoffs get announced, not small cuts, not restructuring. We're talking tens of thousands of jobs disappearing in days. In September 2008, major banks and corporations started firing people by the thousands. Lehman Brothers collapsed. Merrill Lynch got sold in a panic. AIG needed a government bailout. The entire financial system was imploding in real time. Second, credit freezes. Banks stop lending to everyone. Businesses that need short-term loans to make payroll can't get them. Consumers trying to refinance mortgages get rejected. The flow of money through the economy just stops. It's like the blood supply getting cut off. And without credit, the economy suffocates. Third, volatility explodes. The VIX, the market's fear index, shoots through the roof. Stock prices swing wildly. 5% drops in a single day, then 3% rallies, then 7% crashes. Investors are in full panic mode, trying to salvage whatever they can. Fourth, insider selling surges. CEOs and CFOs who have spent months telling everyone that everything is fine suddenly start dumping their own stock. They know what's coming. They're getting out while they still can. And when the people running the companies bail out, that's your final warning. Fifth, media panic headlines. Suddenly every news outlet is asking, is this the start of a recession? Are we heading for another 2008? Should you sell everything? But by the time the media wakes up, it's already too late. The crash has begun. Stage 3 is when the fire alarm goes off. But by then, the building is already burning. In 2008, anyone still holding stocks when Lehman collapsed lost 50% or more in the following months. There was no time to react, no time to reposition. The exits were jammed. The only way to survive a crash is to see it coming before stage 3. The only way to protect your wealth is to act in stage 1 or stage 2 when you still have time. So where are we now? This is the question that matters. Where are we on this timeline right now? Let's go through the checklist and look at the data as of December 2025 yield curve. Check. It inverted back in 2022 and stayed inverted for over a year, one of the longest inversions in history. Now it has steepened significantly. And here's what most people don't understand. The danger doesn't come during the inversion. It comes after the curve steepens. That's when the recession actually hits. In 1929, the crash came after the curve steepened. In 2008, same thing. The inversion is the warning. The steepening is the trigger. And we've already watched it steepen. M2 money supply? Check. For the first time since the Great Depression, M2 contracted in 2023. It's shown minimal growth since then. That means the money flowing through the economy has barely recovered. The bloodstream is barely moving. And when money supply stalls, economic activity stalls with it. Unemployment? Still relatively low on the surface, but look closer. Initial jobless claims have been ticking up slowly but steadily. Full-time jobs are being replaced by part-time gigs. Multiple job holders are at record highs. That's not strength. That's people scrambling to survive. The official unemployment number looks fine. The reality underneath is deteriorating. Corporate earnings? Check. Several major tech companies have issued warnings. Profit margins are shrinking. Revenue growth is slowing. These are the giants that carried the market for years, and now they're admitting the momentum is fading. When the strongest companies start struggling, it's a sign the foundation is cracking. Credit card delinquencies? Check. This is the big one. Delinquencies have continued rising at alarming rates. Auto loan defaults are climbing. Consumer debt is at all-time highs. And the savings cushion from the pandemic? Gone. People are maxed out. They're choosing which bills to pay. And when consumers break, the entire economy follows. Stock market? The S&P 500 has been volatile but remains elevated. And that's exactly the problem. Just like 1929, just like 2007, the market always peaks right before the fall. It's not a sign of strength. It's the final illusion before reality hits. So where does that put us? Based on the data, we're solidly in stage 2 now. The early warning indicators have been flashing for months. Now the transition indicators are fully lit up. Unemployment ticking higher, earnings warnings appearing, delinquencies accelerating. The cracks are becoming visible. If history holds, we're looking at 2 to 6 months before we hit stage 3. That puts the danger zone somewhere between early and mid-2026. Imagine we're on a highway. Stage 1 was the first warning sign we passed miles ago. We're well past the second warning sign now, and stage 3, that's the cliff ahead. We can see it coming. But most people are still accelerating. Some analysts say we'll avoid recession this time, maybe, but the data says otherwise. And history never lies. Every single time these indicators lined up like this, a recession followed. Every time. We're not at the cliff yet, but we're closer than most people think. Your gut feeling that something is wrong, that instinct telling you to prepare, it's right. The data backs it up. But here's the critical part. You're learning this now, while there's still time, while you can still act. That's the difference between surviving and getting crushed. So what can we do? The answer is not fear. It's awareness. It's preparation. Here are 5 concrete steps you should take right now if we're truly in stage 1 transitioning to stage 2. First, review your portfolio allocation. This doesn't mean panic sell everything. It means reduce risk. If you're heavily weighted in stocks, consider shifting some to cash or bonds. In early 2007, those who rebalanced their portfolios toward safety preserved their wealth. Those who stayed fully invested lost half. Don't wait for the crash to make this move. Second, build an emergency fund. 6 to 12 months of living expenses in cash. Not invested, not in stocks. Cash. When stage 3 hits and companies start laying off workers, you want a cushion. You want the ability to weather the storm without being forced to sell assets at the worst possible time. Third, reduce discretionary debt. Pay down credit cards, avoid taking on new loans. When interest rates are high and credit conditions are tightening, debt becomes a trap. The less you owe, the more flexible you are when the economy shifts. Fourth, watch the indicators. Keep an eye on unemployment claims. Track corporate earnings warnings. Monitor delinquency rates. You don't need to be an expert. Just stay informed. The more you understand what's happening, the better decisions you'll make. Fifth, don't panic sell. But do prepare. Have a plan. Know what you'll do if the market drops 20%. Know where you'll move your assets. Know how you'll protect yourself. Those who prepare win. Those who panic lose. This isn't about fear. It's about readiness. In 2008, the people who saw it coming in 2007 and acted early saved their wealth. The ones who waited, who hoped it would pass, lost everything. The timeline is clear. The pattern is repeating. The choice is yours. If you found this helpful, smash that like button, subscribe, and drop a comment with your thoughts. Are we in stage 2? Let me know below. Just a reminder, I'm not a financial advisor. This video is for educational purposes only. See you in the next one.